morning friends, hope you're all doing great. Today we shall be concluding our capital gains tax chapter. We are only left with a few reliefs, the two major ones being holdover relief and entrepreneur's relief. In the previous session we had done about rollover relief. Now rollover relief was happening when you're actually selling off a qualifying asset, business asset, and buying another qualifying business asset. Let's have a look at the scenario wherein holdover relief becomes applicable. Now holdover relief happens when basically instead of selling the asset, you are gifting away the asset. When the asset is given away to the from the transferor to the transferee as a gift, definitely no selling price is involved. So you just gifted away the asset, you have parted away with your asset. In return of your asset, because you haven't received any money, why do you think you should be liable to pay capital gains tax? One, you've lost your asset, you've gifted it away, and secondly, you've not even received any consideration for it. So definitely some way out we should be able to find out which is going to make us not liable to pay any CGT liability. On the other hand, the transferee, the one who is receiving the gift, is the one who has received the gift. The asset is with them now, and also they haven't paid out any consideration for the same. So definitely he is the one who should be liable to pay capital gains tax. So let's have a look at the rules for holdover relief. Now the normal calculation of a gain as a gift basically happens when the disposal by way of, let me just grab a pen if I can grab it here, right. So the disposal is by way of gift, is a chargeable disposal in spite of the fact that the transfer hasn't received anything and not received any proceeds from the transfer. Here, let me just open up my notepad as well. Right. So holdover relief, what is happening? There is a gift of asset from transferor, let's assume it to be A, to the transferee, which is, let's assume it to be B. Now because it's a gift, there is definitely no sales consideration. There is no sales consideration, but for taxation point of view, we will assume that the deemed proceeds of this gift is the open market value of the asset. So the proceeds will be equal to the deemed proceeds, which is equals to the open market value of the assets. So if you had not gifted the asset, if you had regularly sold the asset, you would have received an X amount of money. So the same X amount of money would be considered to be the deemed sales proceed in case of the asset is gifted away from the transferor to the transferee. So now till now we are doing in the hands of A, who is the transferor. So what do we know so far? That the sales proceeds is equals to the open market value. Now this open market value you're going to compare with the original cost of the asset. So you reduce the original cost of the asset and arrive at the gain which would have been there had you not gifted away the asset but would have sold it at the open market value. So this gain is very much like a notional gain. So what do we do after this? Now this gain is a notional gain. It hasn't actually arisen in the actual, right? So what do? You need to definitely try and change the transferor's liability of capital gains tax from the transferor to the transferee. Why? Because the transferor has not actually made any gain. There is only a notional gain. So this amount of gain can be reduced, can be claimed as a holdover relief, thus reducing my CGT liability to be 0. So basically this is how we reduce the transferor's liability. We reduce it from the transferor to the transferee. So now the entire gain amount has been claimed as a relief by the transferor. Let's have a look at the rules again. Right. So the gain is calculated by comparing the deemed proceeds, that is the open market value of the gifted asset, with the cost of the asset. Now this asset, this gain which is there, is a notional gain. So the deemed proceeds become what? They definitely become the cost of the asset to the transferee. Why? It's a very normal scenario. Let me quickly jot that down again for you. Right. Now supposingly A has transferred to B any asset, say worth at a cost of £100. So this sales proceeds of A, that is £100, become what? The same become the cost of B for the asset. So similarly here, now what is happening, because there is no sales proceed, instead of the £100 there is a deemed sales proceeds of £100. So the same deemed sales proceeds of £100 will become the cost of B. So the similar concept lies, even if it is not an actual sales proceeds, the deemed sales proceeds will equal to the cost of the transferee, which is B in our scenario. So now let's see what happens up next. Right. So now how do I basically claim this relief? Operation of the relief is very simple. What I do, the gifts relief operates by holding over the transferor's gain against the transferee's base cost, that is, no amount is chargeable on the transferor at the date of disposal, and the cost of the asset to the transferee becomes the deemed proceeds value to the transferor less the held over gain. So just what I had just shown you in my computation sheet. The transferee will in turn be able to hold over this gain if he makes an onward proceeds of the asset. Now let's have a look at what happens in the hands of the transferee, that is B, the one who has received the gift. Let me open up my notepad again. Right. So in the hands of B, who is the transferee, what is the, whenever he sells off the asset, definitely that becomes the sales proceeds, which is going to be the full market value of whenever B is going to sell off the asset subsequently after use, or just gives it away, or just sells it off, right? Now what do you reduce? You reduce the cost from it. Now cost was what? Cost was equals to the deemed proceeds, which was equal to the open market value in the hands of A, which he would have received had he sold it in the open market value, that is a deemed proceeds of the sale. Now from this deemed proceeds, what do? You reduce the amount of holdover gain which A had enjoyed, so that the taxation liability now levies upon B. So this cost gets reduced. You reduce this cost by the amount of holdover gain enjoyed by A. Thus your net cost is now a lower cost. Thus your gain is now a higher gain. You are now liable to pay CGT liability. Very simply, let me just put some numbers to it so that it becomes more understandable to you. How we do it? Supposingly A has gifted away the asset to B. Right now A has gifted the asset to B. Because it's a gift, there is no sales consideration. Had this asset not been gifted, the open market value this asset would have fetched for A is, say, equals to £1,000. I'm just assuming this figure to be £1,000, right? Originally this asset was purchased by A at a cost of, say, £700. Right? So now let's calculate what happens in the hands of A to start off with. In the hands of A, we are going to assume to this the sales proceeds to be equals to the open market value of the asset, which is equals to how much? Which is equals to £1,000. My pen is just broken or something. Right, so my proceeds are now my deemed proceeds, which is the open market value of £1,000. From these I reduce the amount of the cost of the asset, which was say 700 pounds, 300 pounds of notional gain has been made on the asset. Now because this gain has actually not been realized by A, what I want to do by using this relief is that I want to transfer the CGT liability from A to the hands of B. Why? Because the benefit has been enjoyed by B. So let's have a look at how this I am actually practically able to do. So this entire notional gain, because I actually haven't made this gain, I'm going to claim it as a holdover relief. So I reduce a holdover relief of the entire 300 pounds, thus reducing my chargeable gain subject to CGT to be equals to 0. So very clearly what have I done? I've reduced the liability, right? So I've reduced the liability in the hands of, from the hands of A. Let's have a look at now what happens in the hands of B. Now B, who received the asset, keeps this asset and subsequently sells off this asset. Say, let's assume that B subsequently sells off the asset for say 1500 pounds. Right? So now let's have a look at what happens in the hands of B. Now because the sales proceeds are clearly 1500 pounds, I'm going to reduce the cost. Cost was originally supposed to be how much? Cost was supposed to be the sales proceeds, which is 1000 pounds. Sorry, which is £1,000. However, I need to reduce this cost with the amount of holdover relief enjoyed by the transferor, which is 300 pounds. Thus, my net cost now comes out to be 700 costs, thus making me liable to chargeable gains tax. Chargeable gain is now 800 pounds. Had this asset not been a gift, what would have happened? Very simply, in the hands of A, he would have received 1000, cost was 700, gain was 300, would have paid CGT on this 300 pounds. In the hands of B, who would have bought the asset for say the same 1000 pounds and subsequently sold for 1500, the cost would have been 1000, thus making the gain to be 500. Thus liable to pay CGT. So now very simply what has happened, because this was not a sale, it was a gift. So this 300 pounds of gain, this gain has now been transferred to the transferee, and he ultimately is paying tax on the entire 800 pounds, which is very well a summation of the original 300 plus the 500 gain which he has made. So with the help of holdover relief, we are now, because there is a gift, we are now able to transfer the liability from A to B. Why? Because the asset has been gifted off. Very simply, let's try and understand what happens that instead of a out and out gift, what happens if this is a sale at undervalue, which means had you gone on to the open market value, you would have sold it for say 1000 pounds. But now what A has done, instead of selling it off for 1000 pounds to B or gifting it away free to B, instead of the open market value of 1000 pounds, he's realized he's given it away at an undervalue of say 700 pounds. So quite clearly some sales consideration has been received and some amount of gift is also there. So now let's have a look at what happens when there is a sale at undervalue. Definitely some component of the proceeds, the open market value which you would have got, has been split between actual sales. This actual sales will realize you will definitely give you some sort of realized gain, and there is also a gift element which definitely would be as usual eligible for holdover relief. So very clearly we know that how to basically form these reliefs, how this open market value, if the sale is at an undervalue, it forms some part of actual realized gain which definitely you will be liable to pay CGT liability upon. This is a holdover relief, thus in the hands of transferor there should be no CGT liability on it. Now that we've done it, let's have a quick look at the rules as well. Right. So operation of the holdover relief. Gifts reliefs operate by holding over the transferor's gain against the transferee's base cost. So basically what happens, the transferee will in turn be able to hold over this gift, this gain, if he makes, instead of selling it off at an open market value, a subsequent sale, another gift of the asset is done. So very simply what it means is that A gifted the asset to B, claimed a holdover relief. Now CGT liability has passed on from A to B. Now B would be again be able to pass on this CGT liability if he, instead of selling this asset, again gives this asset like A had gifted to C. So again he would be able to hold over this amount of gain relief and not pay any CGT liability, which now is going to be transferred to C instead. So very simply, by gifting away assets instead of selling them at open market value, we are able to transfer the CGT liability from the transferor to the transferee. Let's have a look at the rules again. Right. However, if he sells the asset for full consideration, that is B is selling off the asset for full consideration, definitely the held over gain becomes accessible in his hands. A partial form of the relief also operates where the disposal is sale at undervalue, that is a sale at a price below the open market value has happened. Then there is some element of gain, there is some element of realized gain. So similarly what you will have some element of the gain you will have to pay CGT upon, and the amount of held over, the amount of notional gain you can transfer to the transferee by claiming a held over relief. Very simply, so what it is, let's have a look at what are the conditions, the perks that needs to be complied to before you are able to comply, before you are able to avail this relief of holdover relief. So what are the requisite conditions for availing this relief? The conditions therefore being that the gift must be made by an individual. Definitely companies cannot escape their CGT liability by transferring the assets by way of gift. Held over relief can only be enjoyed, can only be claimed by a individual assessee. So the individual assessee can transfer the asset by way of gift and thus transfer the CGT liability as well. Also, the gift must be a qualifying asset, which very well means that you cannot be gifting away any XYZ asset of the assessee and claiming a held over relief. It needs to be a qualifying assets. Now what is this qualifying assets? What sort of assets can be transferred, thereby claiming a held over relief? It can be an asset used in a trade, profession or vocation carried out by the transferor or by his personal trading company. Now remember, what was a personal trading company? A company in which you hold more than 5% of the ordinary share capital of the company, that is known as the personal trading company of the firm. Shares and securities in an unquoted trading company. Definitely yes, that is also your asset which you can gift away and avail a hold over relief upon. Shares and securities in the transferor's personal trading company, which I have already told you, that is one in which you hold at least 5% of the share capital. So a taxpayer's personal trading company is one where the relevant taxpayer is a shareholder possessing shares carrying at least 5% of the company's voting rights. So if it's a personal trading company, you've held in shares or you've transferred an asset which was used in the trade or profession of the assessee, very well, you've transferred by way of gift, you can claim a held over relief and transfer your CGT liability to the transferee instead. What else? Now what happens, supposingly, very well, it's a practical scenario, that what happens that instead the asset which was gifted away was not 100% used in the business of the asset. There was some partial use, was personal use as well. So now the scenario clearly says that the asset should be in the business use of the assessee. If there was a proportionate private use, definitely that private use you cannot claim as a hold over relief, very simply because it doesn't qualify for the conditions for you to avail a hold over relief. So very simply what you have to do, you have to transfer the asset, or the hold over relief can be claimed only up to a point, till the point you have actually got how much? Till the point the asset is used in the business of the transferor. So very simply, that is the amount of relief that you can claim as an assessee. Now let's have a look at what simply are the rules for non-trade use. Let me quickly grab some water quickly then. Right. So any gain or a part of a gain which is not attributable to the trading use of an asset is definitely what? Is ineligible for relief. Why? Because definitely the condition that it needs to be used in the trade is not being qualified. It is for private use. Any private use, that proportion you cannot claim as a relief. Also, where the disposal is of shares in the transferor's personal trading company, the restriction for non-trade use is applied by multiplying the gain with the fraction of open market value of the chargeable business assets divided by the open market value of the chargeable assets of the company. Very simply what I am saying, that if the disposal I am referring to, let me just open a page. If the disposal is of shares which belong to the personal trading company of the assessee, which means he's got more than 5% of the share capital, what you need to do, the amount of the gain needs to be proportionately fractioned, proportionately multiplied by the open market value of the chargeable business assets divided by the open market value of the chargeable assets. So chargeable business assets divided by chargeable assets. Very simply, very clearly what it is, we are going to multiply the amount of gain that you've made by the open market value of the chargeable business assets divided by the open market value of the chargeable assets. So now let's have a look at what is this chargeable business asset and what are these chargeable assets. So chargeable business assets are equals to goodwill. You can also add land and building. You can also add plant and machinery, unless it is already exempt, which includes motor cars. So plant and machinery, unless already exempt from CGT purposes, example would be like a motor car. All of these are your chargeable business assets. When in your chargeable business assets, you add, go back to my sheet. Right, so now when in your chargeable business assets, add up investments of the company as well, you arrive at the chargeable assets of the firm. So very simply what it is, in your chargeable business assets, which is a summation of goodwill, land and building, plant and machinery, when you add up these chargeable business assets, when you add investments onto it as well, it becomes your chargeable assets. So what did we have? We had to multiply our gain with the fraction of open market value of goodwill, plant and machinery, land and building, divided by open market value of goodwill, plant and machinery, land and building, and also add investments onto it to arrive at your open market value of chargeable assets. Not chargeable business assets, but when investments are added, they become chargeable assets instead. So very well, let's have a look at how we basically do it. So open market value of the chargeable business assets is divided by the open market value of the chargeable assets. What chargeable business assets are, we already know. We add investments to it to arrive at your chargeable assets as well. What else? Now this claim must be made within 4 years of the end of the tax year. So basically for 16-17 claim must be made by 5th of April. Oops, what am I doing? Let me just get back to my right. So let me just open up a notepad. So you can just read this date to be 5th of April 2021 for a 16-17 claim. Also this claim must definitely be made. It must be a joint claim by the transferor as well as the transferee. Why? Because one is transferring the liability to pay capital gains tax from the hands of the transferor to the hands of the transferee. Definitely both of them must agree in front of the HMRC. They must give a joint declaration that yes, A is transferring the liability from A to B, and B must acknowledge that yes, the liability of CGT now lies upon me, who is the transferee of the asset. Why? Because I have received this asset as a gift from the transferor, who is A. Very well, let's have a look at a few examples and better understand the logics that we've done so far of holdover relief. So Gino gave his ice cream manufacturing business to his son Marco on the 1st of June 2014, when the market value of the goodwill, the only chargeable asset, was £100,000. Gino had acquired the assets or all goodwill for £10,000 on the 1st of May 1997. His son sold the business on the 1st of October 2017, when the goodwill was worth £160,000. You need to calculate the gains arising from the when Gino transferred the asset to Marco in 14-15 and upon subsequent sale by Marco in 17-18. So let's have a look at how do I calculate this operation of the relief. So very well, let's start with the first being the 2014-15 working, where what happens? Consideration is going to be considered the deemed consideration, which is the open market value, which is what? The open market value was £100,000. Right. Now from this £100,000 you reduce the cost, which was £10,000. Thus the gain is 100,000 minus 10,000, which is equals to 90,000 is the amount of gain which has been made. This gain has actually not been realized by Gino. Why? Because he, instead of selling it at £100,000, he is actually gifted away the asset to his son Marco for a nil consideration. So this entire amount he should be able to claim as a held over relief and transfer this total liability of, transfer this total liability of £90,000 from the hands of Gino to Marco, who has actually received the property. So this is in the hands of Gino. Let's calculate what happens in 2017-18 in the hands of Marco, who's now subsequently sold off this asset. So he sold off this asset for a consideration. What is the consideration he's received? £160,000. Very well. We need to reduce the cost from it. Now what is the cost of this asset? The actual cost, which is the deemed proceeds, which is equals to £100,000. You're going to reduce this with the amount of held over relief enjoyed by Gino, which is £90,000, thus reducing the cost from the original £100,000 to only £10,000, thus making him liable to pay CGT on a chargeable gain of £150,000. So this becomes the chargeable gain in the chargeable. What have I done? So this becomes the chargeable gain in the hands of Marco, who has subsequently sold off the asset which he had received as a gift from his father. So his father definitely should not be paying any taxable tax liability because he did not receive any consideration. Because the consideration was not received by Gino, he had paid no tax. The entire amount he was able to claim as a held over relief. The consideration was subsequently received. The benefit was received by son Marco, who is now paying the liability, the CGT liability. When does it arise? On the subsequent sale of the gifted asset. Very well, let's have a look at another example now. Now we are going to do an example where the asset is subject to partial trade use. Simply know your rules. When there is partial trade use, the entire amount cannot be relief, cannot be claimed as a relief. Why? Because only the trade use of the asset can be claimed as a held over relief. The remaining amount, the private use of the asset, needs to be paid on as CGT liability straight away. So let's have a look at a scenario. Gerald gave his business to his son Daniel on the 1st of January 2017. The only chargeable asset of the business is a freehold property that Gerald acquired on 10th of May 1995 for £100,000. The property is 60% used as an office of the business and 40% let as residential accommodation. The freehold was valued at £350,000 on the 1st of January 2017. So very simply, the asset is used 60% for business, 40% for residential purpose. Only 60% of the gain will you be able to transfer as a held over relief. The remaining 40% chargeable liability you will have to pay straight away. So what do? Let's quickly calculate what happens in the hands of Gerald, who has gifted the asset. The sales proceeds will be deemed to be how much? Will be deemed to be the open market value, which was how much? £350,000. From that you reduce the actual cost, which was acquired on 10th of May 1995 for £100,000, thus making gain of £250,000. Now this £250,000, all of it you cannot claim as a held over relief. Why? Because there is a partial private use of the assets. So you reduce your held over relief. You need to restrict the amount of held over relief only to the business use of the asset, which is equals to 60% of the asset was used for business use. So the remaining is going to be taxed straight away. The remaining 100,000, oops, what have I done? 250,000 minus 150,000 is 100,000, which I will have to pay chargeable gain subject to pay CGT liability straight away. The entire amount cannot be claimed as a held over relief. I have to restrict it to the business use of the asset. Now let's have a look at what is going to be the future cost for son, who is Daniel. The future cost is the deemed sales proceeds which is equals to how much? £350,000. This you reduce. Have I put an extra zero? Yes, I have. Right. This you need to reduce by the amount of held over gain, which is now £150,000. So very clearly my future cost, which I'm going to compare when I subsequently sell it off, future cost becomes how much? My future cost becomes £350,000 minus £150,000. Oops. Right, so very simply what we've been able to do, we now know that we calculate our held over relief on the business use of the asset. Whatever was the business portion is what I can claim as a held over relief. The rest of it I need to pay my CGT liability straight away. Let's do another question, practice on this. Let's have a look at another question. Right. Mr. Jones gave 30,000 ordinary shares in Cross Limited to his son on 16th of June 2016 when they were valued at £400,000. The shares, which consisted his entire shareholding in Cross Limited, cost him £150,000 on the 16th of October 1994. The company's issued share capital is £100,000 ordinary shares, all of which carry voting rights, and its assets on the 16th of June 2016 were valued as follows. So we have been given a whole list of assets and how they've been valued. Now remember, your chargeable business assets and your chargeable assets. Chargeable business assets comprise of what? Goodwill, plant and machinery, land and building. In this chargeable business assets, when you add your investments as well, you arrive at your chargeable assets. So very simply, what do we have? We've been given freehold factory, chargeable asset. Goodwill, we know, yes, chargeable asset. Investment forms part of chargeable assets, not chargeable business assets. Net current assets are not forming part of your chargeable business assets or chargeable assets. Assuming all reliefs are claimed, calculate the chargeable gain assessable on Jones and the future cost in the hands of Jones' son. So very very simply, all I need to do is calculate the, now remember this is what, this is disposal of a shareholding which is a personal trading company. So I need to calculate the relief, multiply the amount of held over relief with the open market value of the chargeable business assets divided by the open market value of the chargeable assets. So what do I do? Let's have a look at what happens in the hands of Mr. Jones, the transferor first. Consideration. Is going to be deemed consideration, which is what? The deemed consideration here is the open market value, which is given to be 400,000 pounds, right? 400,000 pounds is the deemed consideration. From this I reduce the actual cost, which is what? The actual cost is 150,000 pounds. Thus making him a gain of, I don't know why it just gets lost somewhere. Him a gain, why is it going here again? Gain is right, finally I've been able to write gain. So the gain is 400,000 pounds minus 150,000 pounds, which is equals to 250,000 pounds. Now what do I do? Can I claim all of this as a relief? I cannot. I need to multiply this amount of relief which I have with the open market value of the chargeable business assets divided by the open market value of the chargeable assets. Quickly, let's find out what are the chargeable business assets. Chargeable business assets comprise of freehold, factory, which is equals to how much? Freehold factory is equals to 800,000 pounds plus goodwill. Goodwill is how much? Goodwill is 100,000 pounds, making a total of chargeable business assets as 900,000 pounds. On this, when you also add investments, you arrive, investments are worth 50,000 pounds, thus making a total of 950,000 pounds as your chargeable assets. So 950 is chargeable assets. So what do I need to do? This relief which I have 250,000 pounds gets multiplied by or restricted by the amount or by the fraction of open market value of the chargeable business assets divided by the open market value of the chargeable assets, which in turn comes out to be 236,842, thus making 250 minus 236,842. This much, 13,156 pounds or 57 pounds is my chargeable gain, which I need to pay CGT upon straight away. So chargeable gain. Now let's have a look at the future cost in the hands of Mr. Jones' son. So this is going to be the proceeds. Cost is equals to what? Deemed proceeds, which were equals to, the deemed proceeds here were equal to 400,000 pounds. You reduce this deemed proceeds with the amount of held over gain, which is equals to 236,842. Thus my future cost of this asset now becomes 236,842 1,63,157 pounds. So very clearly this is the future cost of the assets, which I'm going to reduce from the then subsequent sale consideration when I subsequently sell off this asset at a full market price. So very simply what we have, let's quickly revise the rules for held over gain. Held over gain arises when? At the time of when there is a sale at undervalue or there is an out and out gift of the asset. So what do? My sales proceeds will be equal to the deemed open market value less cost. I calculate my gain, the entire I claim it as a held over relief and pay zero liability. This amount of relief needs to be restricted to business use, or if the asset is a shares in the personal trading company, then what do? The amount of gain that has been made gets multiplied by the amount of open market value of chargeable business assets divided by open market value of chargeable assets. So very clearly I know how to reduce my gain. This is the amount of held over relief that I can claim. Now this was in the hands of the transferor. What happens in the hands of the transferee instead? In the hands of transferee, what have I done? Right, so let me grab my pen again. Right, so in the hands of transferee, what happens? The future cost of the asset for the transferee becomes the deemed proceeds less the amount of held over relief, thus reducing my future, thus reducing the cost in the hands of the transferee, thus making him liable to pay a higher amount of tax when this asset is subsequently sold off by the transferee of the asset who had received the asset as a gift. So that was all for the holdover relief. Let's now have a look at what happens. Let's quickly go through the rules at sale at undervalue. I don't think so we had done it as of now, right? Right. Let me just get back to my slide. Right. So now what happens when this sale is not an out and out gift, which means that instead of just gifting away the asset, some consideration I have received for the asset. Definitely, because some consideration has been received, this some consideration is going to make me have some portion of realized gain. This portion of realized gain is what I am going to pay tax at straight away. The remaining, the portion of the gift element, which is a pure gift, I can still claim as a held over relief. So let's have a look at the rules for sales at undervalue. If the transferor sells the asset for less than its open market value, this is a sale at undervalue or is a partial gift. In this case, gifts holdover relief is available. However, this relief is subject to the normal conditions. That what you do for only the gift portion, you have the normal holdover relief. For the part which you've actually realized the gain, you need to pay tax on straight away. Open market value of the asset at the date of asset, not the lesser amount of actual consideration, is used to calculate the amount of chargeable transfer gain before the held over relief. However, the receipt of sales consideration will reduce this holdover relief if the actual consideration exceeds the allowable cost for CGT purposes. That is, if there is any portion of realized gain some portion of gain I have actually realized, then definitely yes, I need to pay tax on this realized gain straight away. Anything that is a pure gift, definitely yes, I can pass it on and claim a holdover relief on it. So very simply, let's have a look at an example and better understand how to put this to numbers. So what do we have here? Let's have a look at another example. Right. So Angela bought an asset on the 29th of June 1990 for £100,000 that she always used for the purpose of her business. She sold it to her daughter on the 1st of October 2016 when it was worth £240,000, but it was sold to her daughter for £120,000. So instead of selling at the open market value of £240,000, it has been sold to her daughter at an undervalue, which is £120,000. So definitely it is what? It is a sale at undervalue. So let's have a look at the requisite rules for sale at undervalue. So what do I do? In the hands of Angela, let's have a look at what do we do. I assume my sales consideration to be the full open market value again. So consideration, like till now I've already been doing, right? So my consideration is equals to the deemed open market value, which is £240,000. From this, I reduce my actual cost, which is, it was bought for £100,000, thus making a gain. Gain amount is how much? Oops, wherever. Where have I gone? Which column is this? Right. Thus making my gain to be equals to how much? My gain is now equals to minus. So £140,000 of gain I would have basically claimed a relief. However, how much of this I cannot claim? Why? Because out of this I've actually made some portion of realized gain. So let's have a look at what is my portion of realized gain. The amount of relief, I can reduce it to the amount of, I have to reduce it to the amount of gain I have actually made, which means I sold off the asset for, actual sale is for how much? Actual sale is for £120,000 when I had actually bought it for £100,000. So £20,000 is an actual gain which I have made on the asset. So this £20,000 definitely I need to pay tax upon straight away, which very simply means that what it is, out of this total £140,000, I need to restrict my relief to the amount of actual gain I have made. So the maximum held over relief which I can claim is the actual consideration, which is £140,000 minus the amount of realized gain, which is, I have to restrict it to £120,000, thus making the balance 20,000 is what I have to pay tax upon straight away, and I should be paying tax upon it straight away. Why? Because this is definitely my realized gain. I should be paying my CGT liability on this realized gain of £20,000. I bought this asset for £100,000. I've sold it for £120,000. Definitely 20,000 is my realized gain. I should not be allowed to claim it as a relief. Similarly, what happens in the hands of Angela's daughter? What happens in the hands of Angela's daughter? What is the future cost the future cost of Angela is going to be considered the deemed proceeds, which remains the same basically. Oof, this is the future. No, why it keeps writing things here and there. So the deemed cost, deemed proceeds, which was equals to how much? 240,000 pounds, reduced by the amount of claim less the held over relief. How much have I claimed as a relief? I have claimed 120,000 pounds as a relief. So my cost now becomes 240 minus 120, which is 120. Becomes my future. Ooh, why typing here and there? Becomes my future cost of the asset. Very simply, keep your logic straight. If some portion of the gain has been realized, definitely you need to pay tax upon it. If nothing has been realized, you can claim it as a entire amount, as a relief can be claimed by you. So very simply, the logic for my held over relief remains same. In case of a gift or a sale at undervalue, any amount of gain that is an actual gain needs to be paid tax upon straight away. Any amount of gain which is actually not realized, I can give it away. I can claim it as a held over relief. Now that we are finished with held over relief, let's start the last portion of our capital gains tax, which is about another relief, which is referring to entrepreneur's relief. Now before I start, let me quickly grab some coffee, please. Right, so let's now start with the last leg of our capital gains tax, which is another relief that we have to do, which is about entrepreneur's relief. Now to give you a brief backup of what this entrepreneur's relief is, come to think of it that as an entrepreneur, which means that you've started up your own business, you have taken all the risk that an entrepreneur is supposed to take, and on any disposal of the asset, you're now being asked to pay capital gains tax liability. So this is like an incentive or a relief which HMRC is allowing you to make chargeable disposals at a less than the requisite band rate. So very simply, what do we have? Let me just grab my notepad. Right. So what do we generally have? Where do I start off with? I pay my chargeable gains tax, which is CGT, either at a basic level of, if I'm a basic rate taxpayer or I'm a higher rate taxpayer, either I'm paying at 10 or 20, or I'm paying at, sorry, 20 should have been here. Right, so if either I pay the basic rate of 10 or 20 if it's any normal asset, or I pay the basic rate of 18 and 28 if I'm talking about a sale of residential property. So these are the applicable tax rates to me. As an entrepreneur, HMRC allows you to enjoy disposals and be taxed on these disposals at the lowest bandwidth, which is, the lowest rate is 10% instead of the normal 20 or 28 or 18 be applicable to you. So whatever be the applicable tax rate, you would be liable to pay CGT at the lowest rate of 10%, only up to a lifetime allowance of 10 million pounds. So chargeable disposals worth 10 million pounds can be made and paid tax at a lowest CGT applicable rate of 10% instead of the higher applicable rate of 20, 28 or 18 in case of a residential property. So very simply, entrepreneur relief is a lifetime allowance. Now remember, this limit, which is 10 million is like a lifetime allowance for the taxpayer to pay basically of net gains is be applied as a lifetime allowance. It's not, it doesn't come to you every year. Throughout the life of your trade, you can enjoy the lowest rate of 10% up till disposals, until the gain of 10 million pounds. So let's have a look at the rules quickly. Right, so entrepreneur relief allows personal taxpayers to benefit from a preferential tax rate on significant disposals of their business assets. Now remember the term here, we are talking about significant disposals, not normal disposals, but it has to be a material disposal in order to qualify for entrepreneurs relief, that is paid tax at the lowest applicable band rate of 10% instead. So what is this relief now? Entrepreneurs relief means that a rate of 10% instead of the normal 18 or 28 is applied from net gains up to 10 millions arising from one or more disposals of assets or shares. So you've made disposals, you've made a gain. Gain would always be net gains, which is gains less the losses of the year. So whatever net gains you've made up to 10 million of your net gains, you can pay tax at the lowest applicable band rate of 10% up till the lifetime allowance of 10 million has been consumed by you as an individual taxpayer. The 10 million limit is a lifetime allowance for the taxpayer rather than a limit applied to each relevant disposal. Beneficially, capital losses relating to disposals of assets not eligible for entrepreneur relief rate of tax and the annual exemption are applied against gains to the higher 18% or 28% rate. Why? Because definitely we would want to reduce our liability to as lowest as possible. So what do I do basically? Let me just open up a sheet. When I'm calculating my disposals, I do my two separate workings. One for eligible disposals for entrepreneur relief and the other for not eligible disposals. So what do I do from these? I calculate both of these because these would always be taxed at the lowest rate of 10% up till the 10 million threshold limit. Any exemption that I have, which includes my annual exempt amount, any losses that I need to set off, all of these I would do from the higher applicable not eligible rate. Why? Because here I am already paying tax at the lowest possible rate. So here either I am going to pay tax at 20% or 18 or 28, right? So what do? I would definitely want to reduce my liability to as lowest as possible in the area where I am paying higher rate of tax. So any deduction I have to make, I am going to make it from my assets which are not eligible for chargeable disposals. However, gains eligible for entrepreneur rate of tax will be deemed to have absorbed any unused basic rate band before gains not eligible for the normal rates of CGT, which basically very clearly means that if you are making use of entrepreneur relief, paying tax at the lowest rate of 10%, if you still have any unused basic rate band, any unused basic rate band will be deemed to have been occupied or consumed, you can say, by the entrepreneur relief. Means that when you have two category of assets, I told you we are going to make, right? Eligible for entrepreneur relief and assets not eligible for entrepreneur relief. So here I am always going to pay tax at 10%, regardless of the fact that I've still got some unused basic rate band. Here I am always going to pay tax at the relevant higher rate band. So always pay tax at the relevant higher rate band, which is either I am paying tax at 20% or I am paying tax at 28%. If I have what? If it's a residential property, I am paying tax at 28%. If it's a normal property asset, I am paying rate at the 20% higher rate. Never ever, even if I have any unused basic rate band, will be deemed to be assumed, deemed to be occupied, deemed to be consumed by your entrepreneur rate and relief. So very well, because the benefit is already being given to you, you cannot be enjoying the benefit of basic rate band more than once. So anything apart from your assets eligible for entrepreneur relief will always be taxed at the higher rate band, applicable rate band, either 20 or 28. So very simply, what do we have? If the asset is eligible for entrepreneurs relief, I am claiming entrepreneurs relief, the other assets will always be paid at the higher applicable rate. Now let's have a look at the rules again. Right. So now I mentioned that not all disposals, but disposals which are considered material disposal. So let's have a look at which asset is going to be considered a material disposal. Material disposals, the disposals of the whole or part of an unincorporated business owned by the taxpayer throughout the relevant period of the disposal. Also the disposal of shares in a company where throughout the relevant period it's been a personal trading company or the taxpayer has been an employee, full-time or part-time of the company, again would be considered a material disposal. Also, the disposal of one or more assets within the 3 years following cessation of trading of an unincorporated business or personal trading company where the business was owned by the taxpayer throughout the relevant period. So any of these would always be considered a material disposal. Don't worry, the examiner will always clearly tell you when to make use of entrepreneur relief. You need not remember these conditions. Just go through it once. The examiner will tell you to make use of entrepreneur relief or not. Now, by when you must make this claim, the date remains the same, by the 5th of April 2021 for a 16-17 claim. That is by the end of 4 years of the end of the relevant tax year of disposal. Now, let's have a look at a few questions and wind up this session. Let's do question practice. Right. So, what do we have here? Jack commenced trading of an unincorporated business on the 1st of July 1994. He retired and sold his business on the 31st of December 2016. Details of the business asset are as follows. Cost, open market value has been given. So on each of these assets, I can calculate my appropriate gain, whether or not it is eligible for entrepreneur relief. Now here in the freehold offices, it is given that the apartment is 30% of the property was let throughout the period of ownership. So definitely not used for trade. So there is only 70% of the asset is used for business. Eligible for entrepreneurs relief, the 30% of the assets worth, the gain would not be eligible for entrepreneurs relief. Also, I have been given that Jack had made no other chargeable disposals in 16-17 but had an unrelieved capital loss brought forward of 35,000. So definitely out of my gains which are not eligible for entrepreneur relief, I am going to first knock off this brought forward loss. Why? Because I always know that gains which are not eligible for entrepreneur relief will always be taxed at the higher applicable rate. His taxable income for 16-17 is £50,000. Jack has not made any previous disposals qualifying for entrepreneur's relief. So very, very clearly the examiner has told me to make use of entrepreneur relief. So how do I do that? First I'm going to calculate my gains. Where am I lost? My gains on each of these separate categories of assets which I have been given. So first let's calculate it for goodwill. Right, so for goodwill, what's wrong? I don't understand. Why does it keep jumping the cells? Right, so for goodwill, how do I calculate gains? Proceeds minus cost. Proceed is the open market value which is given. So proceeds, which is £500,000. Cost is given to be nil. So the entire 500,000 is the gain that I have made on goodwill. Also, let's find out the next, which is my freehold office. Now very simply I've been given that the proceeds, I sold it for 800,080. However, the cost of the asset was £400,000. Very simply I've made a gain of right. Just show it mathematically to you using the formula. Oops. Where am I lost? Right, using the formula. Why does it not go? Minus. So 480 is my gain on the freehold property. However, it's clearly mentioned that 70% of this was business use, 70% of this was not used for business. So very clearly I have to bifurcate this in 70%, which is going to be eligible for entrepreneurs relief, and the remaining 30% is not going to be eligible for entrepreneurs relief. Why? Because 30% is privately let out by the business. What else do I have? I've also been given some freehold warehouse. So I have a freehold warehouse. Let's calculate the gain on it. Proceeds are equals to £300,000. 420. Cost is equals to 250, thus making a gain of 170 very, very clearly. So now what it is, I've got various assets which I have, few of them, or let's have a look at, let's bifurcate these assets which are eligible for entrepreneurs relief and assets which are not eligible right. So let's have a look at the first asset, which is goodwill. Definitely it is eligible for entrepreneurs relief. So the amount of gain which I have made is going to be eligible for entrepreneur relief. Up next I also have freehold office. 70%, which is business use, is eligible for entrepreneur relief. 30%, which is private use, would not be eligible for entrepreneur relief. Also, I've been given freehold warehouse which is equals to 170 eligible for entrepreneur relief, thus making a total of 100,000, 6,000 pounds eligible for entrepreneur relief and 144,000 not eligible for entrepreneur relief. Now because this is eligible for entrepreneur relief, let's tax it at entrepreneur's relief rate, which is 10%. Very simply, this data which is given here has taxable income of 50,000 is given to you just to confuse you, just to test your rules knowledge, whether or not you know that anything apart from that is not eligible for entrepreneur relief rate would always be taxed at the higher rate. The higher rate applicable here is, it's not a residential property, so the higher rate applicable here is 20% is what I'm going to pay tax. What have I done? Let me just reverse. Right, is equals to the higher rate would always be equals to the applicable higher rate, which is 20% here. Why? Because it is not what it is. It is not a residential property. Oops, I'm so sorry. I forgot to mention one thing. Right, now before I calculate these, I've also been mentioned some brought forward losses. Let me just insert a few lines here. I'm so sorry, I forgot to claim my losses and to also claim my annual exempt amount. Right, so what do? Out of this liability, I reduce my brought forward losses, which is equal, always I reduce it from the higher applicable rate, and I also avail my annual exempt amount, which is equals to 11,100, thus making me liable to pay tax upon how much income have I got left? 144 minus 35 minus 11,100, 97,900 is what I'm going to pay tax at the higher applicable rate of 20%. So thus making my liability to be 19,580 for my, sorry, is it a residential property? Let me just go back to the question. The apartment 30% of property was let during the period. Definitely yes, it's a residential property. Thus the applicable rate is going to be 28% instead. So make sure that you're also very vigilant in the exam. The examiner may very well test your knowledge by giving you these little tricks in the question. So because it's a residential property, the higher applicable rate of 28% is what I need to pay tax on gains which are not eligible for entrepreneur relief. So very simply, what have I done? I first did my working, calculated my gains which are eligible for entrepreneur relief, gains which are not eligible for entrepreneur relief. I reduce any brought forward losses, annual exempt amount from the higher rate band, which is the gains which is not applicable for entrepreneur relief. Why? Because here I am always paying tax at the lowest band of 10% up to the first 10 million of gains which I am making on the material disposals. Now let's have a look at another question. What happens here? Richard is a director of Wallace Products Limited, a trading company. Richard owns 320,000 shares £1 ordinary shares of the company that he acquired at £3 each. So the cost is given. 320,000 shares have been acquired at £3 each. The shares carry full voting rights and represent 10% of the ordinary share capital of the company. So very well clearly the examiner has told you that this is the personal trading company of the assessee. On 30th of September 2016, he sold his entire shareholding when the shares had an open market value of £30 each. So the proceeds are £30 each for 320,000 shares. The breakdown of which of the company's market value is goodwill, freehold land and building, investments, net current assets is provided. Richard had not made any other disposals in 1617 but had made a previous disposal eligible for entrepreneur relief that gave rise to 2 million of gains. Now remember, how much do you have? You have your lifetime allowance of 10 million. Out of this 10 million, you've already utilized 2 million. So definitely amount of gains eligible for entrepreneur relief remaining is 10 minus 2, which is 8 million pounds. Anything apart from that needs to be taxed at the higher applicable rate. So very simply, let's calculate our gain. How do I start? I start with the proceeds, which is 320,000 shares have been sold at a market value of £30, thus making a gain of 9.6 million. From that I reduce my cost, which is the same 320 shares I purchased at a cost of £3 per share. Thus my gain is 864 times 0. Now all of this would have been eligible for entrepreneur relief. However, I have already used 2 million of my entrepreneur relief, thus making me only left with 8 million to be claimed as entrepreneur relief. So eligible for entrepreneur relief and not eligible for entrepreneur relief. How much is eligible? Out of this, I need to restrict it to the 8 million figure. Why? Because 1, 2, 3, 4, 5, 6. Why? Because a portion of 2 million of it has already been used. So the remaining is not eligible for entrepreneur relief. So what do? Definitely this is applicable. Entrepreneur relief rate is going to be paid at the lower rate of 10%. Anything apart from that always gets taxed at the higher applicable rate, which is equals to how much? What have I done? Right. Some of 10%, right? So the remaining always gets taxed at the higher rate. Now this is what? These are shares. So the higher applicable rate is going to be what? Is going to be 20%, is equals to, on these shares I am going to pay tax at the rate of 20%. Right? So very, very clearly I now know my liabilities. How much it is? Oh God, again I forgot to reduce my annual exempt. Please do not forget it in the exams. I know it's just very easy to skip these things. 11,100. Thus remaining is 64800 minus this. This is equals to 628900 multiplied by applicable rate, which is higher rate is 20% is what I'll be paying tax upon gains which are not eligible for entrepreneurs relief. Now let's have a look at another example, a little comprehensive one. Now just come to think of it, this data which is given to you, his taxable income is 200,000, is actually irrelevant in the question. It's only given to you to confuse you that whether or not you actually try and use this figure, try and find out if there is any unused basic rate band left or not. Let me give this to you with the help of an example so that you better understand how this examiner may trick you by giving you an unused basic rate band allowance. But remember, you do not have to use it. Anything apart from what is eligible for entrepreneur relief always gets taxed at the higher applicable rate band. So now what do we have here? Nigel was the owner of Sten Leisure, which is set up in August 1998. On 30th of June 2015, the business ceased trading. On 30th of September 2016, Nigel sold the freehold premises for £750,000 that had cost £300,000 on 1st of January 2005. In the period between cessation of trade and sale, the premises was rented out to another trader. Nigel had made a disposal of quoted shares in 1617 that realized a chargeable gain of £9,000. He had not made any previous disposals eligible for entrepreneur relief. His taxable income is £30,000 and paid £15,000 in personal pension contribution. Remember your rules. Any contribution in personal pension contribution actually results into an extension of your basic and higher rate bands. So don't forget, your rate band will now increase from the original 32,000 plus 15,000, which comes out to be £47,000. Now the taxable income is given to be only £30,000, which means ideally the basic rate band has only been consumed up till £30,000. 47 minus 30, which is £17,000 of your basic rate band, is still left for to be paid tax at the lower rate. However, because we are making use of entrepreneur relief here, everything else apart from the assets eligible for entrepreneur relief will always be taxed at the higher applicable rate. The examiner can very well give this to you just to confuse you. You may be tempted to find out if there is any unused basic rate band and apply the lower rate. But remember your rules. Only assets eligible for entrepreneur relief pay tax at the lowest rate. Any unused basic rate band is deemed to have been consumed by the entrepreneur relief, which means anything apart from that always gets taxed at the higher applicable rates. Let's quickly do this question and then wind up today's session. How much of gains have I made? I've made a freehold property I had. The open market value of this property was how much? It's given to be £750,000. The cost of which was £300,000. So very outrightly I've made a gain of £450,000. Now, how much of this is first attributable to the trade only? Remember, make your timeline. What is happening here? Let me just quickly draw a timeline for you. My pen has dropped. Right. So what do I have? Let me quickly draw my timeline on my notepad here. You acquired a land. This asset was acquired. Purchased when? Let me get back to the question. It was purchased in 1st of January 2005. Right? Thereafter what happens? Sold on 30th June 2015, the business ceased trading. So 30th of June 2015, the business ceased trading. So definitely it now ceases to be used for business purposes. And this asset gets subsequently sold off when? Gets sold off on the 30th of September 2016. So 30th of September 2016 it has been sold off for. So how long is this time frame when it is used for business purposes? This is exactly 10.5 years, 10 years, 6 months, and this time frame is another, how many years? This time frame is another 1 year, 3 months. To 1 year, 3 months to go, right? So 1 year, 3 months. Total life is how much? Total life becomes 11.75 years. So quarter less than 12 years exactly. So how do I basically attribute my gain? I can only attribute to the business use of the asset. So this gain, how much is attributable to business? Out of this total gain which I have made, 10.5 years it was used for business out of the total life of 11.75 years. So very quickly, very clearly, 402128 is what is used for business purposes. The remaining is definitely not attributable to business, thus not eligible for entrepreneur relief. So what do I have here? Let's find out. Eligible. Good Lord. Eligible for entrepreneur relief. Not eligible for entrepreneur relief. What is eligible? The amount that is attributable to business is definitely eligible for entrepreneur relief. What is not attributable to business cannot be claimed a relief for. Now we've also been given that there is some other gain. So let's add this other gain as well, which is how much? 9,000 pounds. Before I forget, let me quickly first reduce the annual exempt amount, which is equals to 11,100, thus making my gain liability, thus making my totals to be equals to the same 402128, and this is now equals to not eligible gain. I got some other gains to add on, and I have some annual exemption amount to claim. So 45772 is what I have left. Now very simply, this is always going to be paid at the entrepreneur rate, which is how much? Is equals to, this gets taxed at the lowest rate of 10%. Now this, remember, as a rule, always gets taxed at the applicable higher rate, which is what? Is it a residential property? No, it's not. So I've got 20% is the applicable rate, which I'm going to pay tax on this amount. Why the examiner has given you all this data is because ideally, had you not been using entrepreneur relief, because you've made some contribution towards your personal pension scheme, your basic band of 32,000 pounds would have got extended by the amount of personal contribution, which is 15,000 pounds, totaling basic rate to be 47,000 pounds. Now, I have been given that my taxable income is 30,000 pounds, which means taxable income is 30,000 pounds, means I still have an unused basic rate band of how much? I still have a basic unused basic rate band of 47 minus 30, which is equals to 17,000 pounds. However, this will be deemed to be consumed by entrepreneur relief, Why? Because I'm making use, let me just wrap it up. Because why? I'm making use of my entrepreneur relief benefit. So definitely this unused data, this unused basic rate band will be deemed to have been consumed by the entrepreneur relief itself. So very simply, all you have to do is that you have only two rates applicable to you, the basic rate of 10% and the higher rate on gains which are not eligible for entrepreneur relief. Do not confuse yourselves in the exam. Follow the simple rules that there are. So either the basic rate or the higher rate. So basic rate for gains which are eligible for entrepreneur relief, higher rate for gains which are not eligible for entrepreneur relief. Now before I wind up today's session, let me quickly go through a little bit of remaining theory, that is how these reliefs interact with each other. Let's have a find out whether entrepreneur relief actually does interact or gets jumbled up, mixed up with rollover relief or not. So rollover relief and entrepreneur's relief cannot interact with each other. Why? Because taxpayer is a company, then entrepreneur relief is not applicable to it. If the taxpayer is a personal company taxpayer conducting a trade, then the entrepreneur relief cannot apply to a disposal of a single asset used in trade. Why? Because under this circumstances, the rollover relief would be applicable. Where the business discontinues as a whole is when the entrepreneur relief kicks in. So if it's just a single disposal, you claim a rollover relief. If the entire business has been seized off, only then you claim a entrepreneur relief. Also, let's have a look at if your entrepreneur relief does coincide with the gifts relief, which is your held over relief. Disposals constituting material disposals for entrepreneur relief could also be gifts of qualifying assets for gifts held over relief, as the condition for both reliefs is definitely very similar. So what do we do as gifts held over relief eliminates a gain from charge to tax in the hands of the transferor. It should be claimed by the transferor in preference to the entrepreneur relief. Why? Because entrepreneur relief, I still have to pay tax at 10%. If I'm claiming a held over relief, I pay tax at 0. The entire amount of gain I'm allowed to take, I'm allowed to roll over and pass on the liability in the hands of the transferee instead. So definitely I will not make use of my entrepreneur relief when I'm gifting the asset. Instead, I will make use of my held over gain. Also, the primary disadvantages of gifts held over relief is the effect on transferee, who will have to pay tax on gain, including the transferor's deferred gain if he sells the gifted asset for full consideration subsequently. So very clearly what happens, let me quickly jot it down for you. So entrepreneur relief and rollover relief do not actually interact with each other. Why? Because this happens on sale of single asset. This happens upon disposal, which is a material disposal, upon winding up of the business. Also, entrepreneur relief and held over relief both may be considered when I have gifted the asset. This results in me paying 10% tax. This results in me paying tax at 0%. Why? Because the entire has been transferred to the transferee. So definitely this is what is going to gain my first preference when I am stuck in a situation where I could actually avail both these reliefs. So very simply follow your simple rules. Stick to the basics of your rules and you should be able to clear your chargeable gains tax. Any of the questions would just follow very simply to you, as long as you know the rules and how to apply these rules. That's it then. That brings us to an end of today's session. As usual, if any query you have, please feel free to email it to me at Shilpi ACCA@gmail.com. .com. That's, oops, what it is. Let me just write it again for you. So it's Shilpi, ACCA at gmail.com. Right? That's it then. Thank you very much for today's session. Thank you.